Simply put, insurance is about managing the risks that are possible in your daily life. Some risks we can manage on our own. An emergency fund can cover small blips, like needing to replace the air conditioning in your car. That is what emergency funds are for. But for bigger financial risks, like getting into a car accident, we need a bigger solution, thus the need for insurance. Insurance companies employ very detail-oriented number crunchers called actuaries to estimate the chances of risk. Consider this stereotyping, hopefully in your favor. Calculations can determine how much a certain negative event would cost, as well as who might be at risk and to what extent. If you'd like to insure yourself against that risk, the insurance company will assign a premium amount to your coverage, like say 3%. Using a simple example, let's say that one person out of 100,000 will experience a certain event. Let's say that event costs $300,000. Without insurance, 1 in 100,000 people will need to pay $300,000, and the rest will have to pay zero. Instead of each person saving up enough to cover the small chance that it actually happens and facing the possibility of going bankrupt as a result, they can share the burden together. If everybody contributes $3 to the pot to total $300,000, that's a lot easier on the wallet. Then, the one person of the 100,000 that ends up needing the money can take it all. Nobody's bankrupt and everybody's happy. When we buy insurance, it's as though we are throwing a little into the pot and agreeing that whoever needs the money can have it. In this sense, insurance is a real-life game of would you rather. Would you rather definitely pay $3 or run the slight risk of paying $300,000? For example, it's possible that you will break a leg if you go mountain biking. Would you rather definitely pay $10 no matter what, but pay nothing more if it happens? Or pay nothing up front, but if you break your leg, pay $5,000? Choosing to pay a small fee no matter what happens is essentially what you do with insurance. Some things are no-brainers, and you should definitely have insurance for them. Other things might be a little gray. At LearnVest, we think it's a no-brainer to buy insurance for anything that would wipe out your savings, or worse, devastate you financially. Now, risks, real or imagined, will always exist in our lives. It's fully possible to go overboard with purchasing insurance. For example, there is a famous insurance company called Lloyd's of London that will probably sell you insurance for just about anything you can dream up, at a price, of course. Afraid of being abducted by aliens? Join over 20,000 Americans and insure yourself against alien abduction. One $10 million policy only costs $25. Thailand insured its tourists, promising $10,000 to any tourist harmed during a political riot. Consider yourself a foodie? You can even insure your taste buds. Many celebrities have been known to insure what they consider to be their best assets. Dolly Parton insured her breasts to the tune of $600,000. So it's possible to take insurance too far. While celebrities are busy placing a dollar amount on their assets by purchasing atypical policies, you're probably engaging in risk management without even realizing it. There are 5 types of risk management: risk avoidance, risk reduction, risk sharing, risk transfer, and risk retention. We all use a combination of these 5 types constantly and often unconsciously. If you find yourself swerving to miss a pothole in the road, you've engaged in risk management in the form of avoidance. You're choosing not to engage in an activity that has a risk associated with it. If you leave your passport locked in your hotel room while traveling, you've engaged in risk management in the form of reduction, by taking steps to reduce the chances that certain loss will occur. More obviously, having an emergency fund is a type of risk management through risk retention. You are avoiding the risk of going into credit card debt by having an emergency fund for when unplanned expenses arise. So you see, not all risk management requires purchasing insurance. Of these different types, risk transfer is when insurance comes into play. With risk transfer, you are shifting the risk to another party, usually through buying insurance. At LearnVest, we think about insurance like this. The more expensive the impact of the event, the more you should consider insurance for it. If the risk is expensive and very likely to happen, well, then we just suggest you avoid it altogether. Understanding what type of insurance you should have also entails understanding your own risk tolerance. Risk tolerance is covered when we talk about investing, but it's also important when we talk about insurance. What types of losses are you willing to deal with if they happen to you? Some people are more conservative than others and prefer to purchase particularly protective insurance plans. There isn't necessarily one right answer. Perhaps you would sleep better at night if you had insurance to protect against being abducted by aliens. It's important to realize that we all have different levels of risk tolerance. Figuring out your risk tolerance will help you decide what type of insurance you need to buy. It also involves deciding what types of benefits you want for each kind of insurance you need. It's the age-old cost-benefit analysis. For example, your risk tolerance comes into play when thinking about trip insurance, which is offered every time you buy an airline ticket these days. Before clicking that you agree to pay the extra $30, stop and ask yourself if you really need it. If you do, figure out what benefits you're looking to insure. Insurance plans aren't all the same, and just because you think, there's a chance Lisa's bachelorette party is that weekend, maybe I should buy trip insurance so I can cancel my vacation plans just in case, it doesn't mean that the insurance plan is going to kick in for that reason. Insurance policies are full of fine print, and you're likely to get what you paid paid for, meaning insurance doesn't come cheap. So ask yourself, do I need this type of insurance at all? What benefits do I want to have if I need to use the insurance? And where should I buy it? For most people, there are 3 categories of insurance that are must-haves. Health insurance is pretty obvious. If your mom is anything like ours, then you're well aware that health insurance is necessary. Property insurance includes your home, whether you own a house or rent an apartment, and your car if you have one. In most cases, you can't own property without also buying insurance, whether because of state laws or your mortgage broker requiring it. Life and disability insurance policies might be a little more confusing. Life insurance is extremely important if you have dependents. Disability insurance is generally considered to be essential, even though most of us would be covered by Social Security's meager disability benefits if we were to become disabled. This has nothing to do with how old you are. Social Security offers more than just retirement benefits. By the end of this course, you'll have a good grasp on each of these policies. More importantly, you'll know what you need to purchase to protect yourself, your stuff, and your loved ones.